Hello, and welcome back. One of our subscribers has been suggesting to take a look at Paramount Global, ticker symbol PARA. And in this video, this is exactly what we are going to do. As usual, I always like to take a little bit of a first look at what is going on with the company stock price. It's down 38% since its 1-year high. If you take a look at the 5-year chart, it had its peak and then it's going down since then. The news of the company are pretty much talking a lot about Warren Buffett, pretty much having this one as it's one of its best yielding stocks here. And for this reason, I kind of wanted to take a little bit of a quick look here at this article, talking about Paramount Global 3.67% yield as of the writing of this article. And you can see here that this is a pretty nice yield, obviously, and the fact that the no-brainer catalyst for Paramount throughout the decade is going to be its streaming push. So the company is pushing, for it becoming a streaming rival, pretty much against the likes of Disney Plus or Netflix, and and more, of course. And we do want to see whether Paramount Plus will be actually achieving some nice additions in terms of subscribers. They have already done that during the second quarter. They have also reaped the rewards of Top Gun Maverick, for example, which propelled the company's film entertainment segment to a greater than doubling in revenue in the June-ended quarter. This is a big company, and it's pretty great in terms of entertainment. So we really want to take a little bit of a closer look and see whether it makes any sense to be entering here, whether it's a good price and a good company, pretty much. Now I'm heading back to our metrics page, and the first thing that you notice here is the P ratio, which is very low, and this is something that I like to see. Now, of course, the stock price has actually gone down significantly, and this actually has helped the P ratio go down. Yet there is always a little bit of a fear of the company having a lot of competition in the streaming service, and this is definitely factored in. Apart from this, the fact that the price to free cash flow is very elevated has a lot to do with the company investing in themselves. Now, in this video, we're going to be talking a lot about the working capital changes, what has been happening with the company's cash flow and the balance sheet. So I think it's going to be an interesting video regardless if you are intending to invest in Paramount, because it can give you a sense of how to actually understand these kinds of metrics in terms of the cash flow statement. And I will actually show you how to use this tool to go through the whole analysis really without ever needing to research anything else. Of course, if you are new around, remember that you can join this tool by becoming a patron. You can find a link in the description box below this video. And while you are at it, please remember to leave a like as well. That helps a ton, and thank you for being around. So, outstanding shares, 650 million, but take a look at this increase. This is something that I hate to see, dilution of shareholders, especially if I bought before this stage. I wouldn't love that. But if you're buying right now, and you're trusting that the company will not be diluting shareholders any longer, maybe it's a good idea, but I really don't like to see that. And it does make some sense because the company did want to fund themselves, for sure, in order to make the streaming push, and they didn't want to either burn a lot of cash, or they also potentially didn't want to get some extra debt, so they resorted to issuing shares. But this is not great for shareholders, and as a potential shareholder myself, I wouldn't like to see that. Okay, in terms of the total ability to free cash flow, this is very elevated here because of the free cash flow that has been going down. You can kind of see it here. There is a reason for this, which we're going to examine, of course. This is what I was telling you earlier, because you may be seeing this one and be like, this is horrible, but there may be a reason for this one, and we need to analyze a little bit further. Again, we're going to use the tool to do that. Now, 100% in terms of the revenue growth, net income growth, 1,000%. That's very awesome here for the company. Total equity also has been going down tremendously, but remember the outstanding shares that has helped with that. Now, the great thing about this company, price to book ratio is very low here, and outstandingly low, I'd say. So I'd love to see it. I love seeing that, and this is actually another metric that is potentially could help me make a decision towards buying this one. With net income margins that are not bad at all, return on equity that is not bad either, and also the dividend yield is sitting at 3.7%, is what we examined earlier. Now, you will notice that the free cash flow payout ratio is very high, but again, we know that the free cash flow has been going down. We will examine why. The payout ratio, though, is 18%, and that's very low and very easy for the company to pay. And as a dividend investor, I would absolutely love to see that. I would be stoked to see that, actually. So this would definitely be one of the companies that will be taking a much closer look, because we can also take a look at the dividends here. And this very nice graph here can tell you that the company has been elevating their dividends pretty much at a 5-cent yield, I should say, every now and then. Now it has been a little bit more scarce, but still happens quite a lot through the years. And you'd love to see that very, very confident and nice increases of its dividend with a yield of 3.7% that has such little payout ratio. That sounds great. The only thing that we really need to know a little bit more about is the free cash flow. Why the free cash flow payout ratio is a little bit lower here. And this is what we are going to examine right now. So let's dive into this one because it's very, very important. Let's take a look at the income statement first. 13 billion, almost 14, 13.7 to 28. That's a massive increase here, more than doubling the revenue. I love to see that, of course. And in terms of the net income, 300 million to 4.5 billion here. Again, pretty much increasing their net income very, very nicely through the years. Now, the balance sheet of the company, take a look at the total liabilities of the company, 35 billion here. And in terms of the total equity, it's sitting at 23 almost billion is what we're seeing, with 20 billion in terms of total debt here for the company. And take a look at the additional paid-in capital, which is pretty much what the company has been making through issuing of common stock, through common stock issuance. And now, the elephant in the room, the cash flow statement. So net income has been increasing, but take a look at this operating cash flow here. It has been increasing through the years, yet 2021 has been the odd one out. Why? We're looking at a change in working capital here that is massive over here. And this deeply affects, obviously, the operating cash flow, which in turn affects the free cash flow. Because what is pretty much the free cash flow? How is it generated? It's operating cash flow minus capital expenditures. And the other thing that we kind of want to see is the capital expenditures are about the same here in terms of investing activities. So what has happened here? What has caused this decline in the change in working capital? Now, when we're talking about working capital, it can be a little bit of a complex topic for people to understand because they can mess up the fact that it's on the balance sheet and it's also in the cash flow statement. Now, when we're talking about the cash flow statement, it kind of shows us the inflows and outflows that have to do with the changes in working capital. So, for example, if we take a look, if we go back at the balance sheet and we examine the working capital, what is the working capital? It's current assets of the company minus the current liabilities of the company. So we can kind of do the deduction pretty much and find the difference between the current assets and the current liabilities. But what the cash flow statement is telling us here is that there was a decline in working capital pretty much. There was a decline in cash flow, so cash was spent, and this actually resulted in a change in working capital. So what could this be? So think about it this way. When the company, for instance, is buying something, for example, a factory, for instance, now they are spending some money there, but they could be getting some long-term debt, right? Because, when you are buying something of this sort, you more than likely get some debt in order to fund this purchase. Now, this kind of debt is a long-term debt, so it is not a current liability. It is a non-current liability, so it is not a part of the working capital. Does that make sense? The current assets minus current liabilities is the working capital. It's pretty much the liquidity of the company for the next 12 months. But a long-term debt that you get for purchasing something big is not affecting the working capital because, again, it's a non-current liability, right? So this should be making a ton of sense here. And you may be also wondering why, for instance, inventory is not directly included in the working capital. It's a separate line. Because think about it this way. Inventory is a current asset. It's about to be spent in the next 12 months. It's regarded as a current asset. And so when you are actually spending money, when you're actually spending cash in order to buy inventory, you are extracting current assets, but you are also getting current assets. So you are paying for them and you are getting them. So this basically nullifies the change in working capital for this, for this case, for the inventory case. So it kind of helps to know these things. It's important to know these things. And if you want to take a little bit of a closer look, again, you can use our tool here. You can go to our company analysis page, and the first thing that I also like to take a look at is the press releases, which is a new module, because it can kind of tell you about acquisitions, for example. Now, for instance, here it tells me some acquisitions that are happening here with an agreement from Warner Bros. So you can kind of see some things that are relevant to the company here. But what is even more important, I kind of want to go to the earnings transcripts page here. Sorry, the SEC filings, that is the one that I wanted to go to. And then I want to find the latest 10K. The 10K, of course, is pretty much the annual entry, the one that tells us about the company's financials. And what I'm going to do, what I could do here is, of course, go through the financial statements and supplementary data and, for instance, go to the consolidated statements of cash flow. But I wanted to find a very specific part here, which I have already highlighted, the cash flows. And of course, you can always dig deeper and read the whole thing here. But what I wanted to display in this case is this specific page here, which kind of displays what happened with the operating cash flow for the company and the investing activities cash flow, for instance. And you will see here in operating activities, the decrease in cash flow provided by operating activities from continuing operations was mainly driven by increased investment in our streaming services, including spending for content, advertising, and marketing, and a higher level of production in 2021 as a result of production shutdowns in 2020 due to COVID-19. So yeah, you can actually see some further details here if you are interested. And this is how you can kind of streamline the whole process by taking a look at the tool and kind of getting the first sense of what is happening with the financials, and then actually digging your way through and digging a little bit deeper inside the actual financials of the company. Now, it's worth noting that the company is an about 17 billion market cap company. And remember that if we go back to our financial statements over here, the cash flow statement, you will see that their typical free cash flow is about 2 billion. So this is about 8 times their free cash flow, which signifies that the company is actually pretty cheap in regards to what they have been doing, for example, in 2020, where it wasn't a really suppressed year, even though they were still spending quite a lot here. And you can kind of see that the company has been generating some nice free cash flow that points to a company that is still pretty undervalued here. So let's take a look at our stock evaluation tool to see how undervalued this company is. Now, you will see that the revenue growth has been 21%, but I don't want to go with such a high value because there is tons of competition, especially for the next 5 years. I feel like this is going to be a warfield in the streaming industry. So I'm going to go lower. I'm going to go, let's just say 4, 6, and 8, be a little bit more solid here. And in terms of the margins here, again, they are nearly 10 to 15%. I'm going to go in between 10, 12, and 14, which is pretty solid here. In terms of free cash flow margins, again, they seem to be a little bit lower than the usual, so I'm going to be a little bit more reserved. I'm going to go 70, 80, and 90, and an annual return of 13% is what I typically like to ask from my stocks. You can calculate here, and you'll see we are all green, and pretty much as easily all green over here. And if we calculate for all this growth that the company could have, and even at a 4% revenue growth with a net income margin of 10%, we are still firmly in the green here. Now, of course, remember, you have to factor all the risk in terms of the company actually doing well with their streaming services, what is going to be happening, and the risk that they have there. But I love the fact that the company has very, very solid dividends here, and their financials are looking pretty nice as well. And again, this kind of decline in free cash flow was predetermined, was actually a board decision here. Lots of things to like in this one. And if I were to be buying this one, would I do that? And the answer is yes, I would definitely be buying this company. It looks nice right now, and even though I'm not a huge fan of dividends, because as I've talked in the past, they are pretty much taxed twice, I still like that. They are also extracting, of course, financial, some assets from the company, free cash flow. But of course, if you want to get this for a, sort of like for a pension, for instance, or for some just passive income, I think this is a very, very solid addition to a portfolio. So I like what I'm seeing here with Paramount. And thanks to our pretty much subscriber and viewer for actually suggesting this company. Interesting to take a look at. I think I took a brief look at it some time ago, but I haven't really deeply analyzed, so that was nice to see. Thanks for watching again, guys, and I'll see you in the next video. Remember to subscribe if you're not a subscriber, by the way, and see you soon. Bye-bye.